Well, hello, everybody. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar on how artificial intelligence and deep learning are disrupting trading, and why now. With that, I'm very pleased to introduce Mansi Singhal, who is with qplum. She's going to give us a brief description about qplum and also introduce our presenter today. Mansi, thank you for joining us. If you can go ahead and unmute your line, I'm going to go ahead and pass you the controls so that we can get underway here today. Thanks, Mansi.
Thanks, Cynthia. Thanks for the opportunity for letting us present this in collaboration with Interactive Brokers. We are very excited about this event, and the response has been great. Just to get started, my name is Mansi. I'm the co-founder and CEO of qplum. We are an online asset management firm, and we are helping many families, individuals, bringing investing as a science. And Interactive Brokers has been phenomenal in terms of not just as a broker and a custodian for many of our clients, but also in terms of increasing the education, the awareness around investing. So we're very excited that we were able to arrange this in collaboration with Interactive Brokers here. I have Gaurav here, who's the Chief Investment Officer at qplum. And without much delay, we'll get started. I just want to point out that please, if you have questions, as Cynthia mentioned, use the questions window at the bottom right on your panel. And we have questions for you for sure. So we will be keeping this as interactive as possible. And we will introduce a lot of questions for you. And we are hoping that everybody who's joined us here will do the same and not hesitate. This is an opportunity for all of us to learn. And that's what we want to accomplish here. So Gaurav, do you want to get started?
Hey everyone, I'm Gaurav. So the topic that I'm talking about today, I know this very well. I could, even if you wake me up at 2 in the night, I could talk about this. This is what I've been working on for about 17 years now. The problem that we're trying to solve, all of us feel that problem. Globally, the industry manages more than $164 trillion, and we as investors pay more than $1 trillion a year. Now, the fact that we pay these fees, that's not a problem. The real problem is that we are no closer to solving the investing problem. As in that all of us, when we want to decide what to do, stocks are too high, should I sell, should I sell a little bit, should I buy more, maybe it's going to go up more, should I invest in this like Snapchat IPO, every single question that we have, and not just us, even the endowment funds and the smartest investors, every one of us are having to start from scratch. We are having to make our own mistakes and learn from that. We are having to form our own rules and see which ones work in the very little data that we get. This problem was better described by Benjamin Graham, whom many consider the father of modern investing. He wrote a paper in 1952, which is called Towards the Science of Security Analysis. And to him, security analysis was investing, so I'm paraphrasing a little bit, where he says that in future we'll be investing with a trustworthy tool and not experts. Now, just keep this in mind. This was 1952, many years before even the first computer was there. He was a portfolio manager, not an academic. He was a very practical man. Warren Buffett chased him to ask him for his only job that Warren Buffett did. A lot of respect for this guy. Then he says that for me to trust this tool, it should know what I know. Otherwise, I'll feel like I can do better. And he says that the tool should be thorough in the sense, if there's some obvious flaw in the company that's there in the balance sheet and the tool is not able to figure it out, then I'll stop trusting it. So being a trustworthy tool requires it to be thorough and to know all that we know about investing currently. The only thing we are adding today is that this tool should keep learning. Presumably, the $1 trillion we pay every year is because of this aspect, that we are investing every year, we are investing to help the tool get better. So what we need to figure out is how to keep learning in a way that we move towards this trustworthy tool. And the answer finally is available to us. It's deep learning. But before I go on and make these high-flying claims, let me sort of give you a little more context about myself and why, let me help you understand what gives me the right to even talk about these things. So I quit PhD in computer science in 2005 to join a small company at the time, Tower Research Capital. I was given about $10,000 of risk, and if I, like any other arcade firm, if I lose that money, I'll be out of a job. That's natural in millenniums and towers of the world. But I did well. Within 18 months, I was making about $70 million a year. Since that time, my strategies have made more than $1.4 billion, and in a very smooth, consistent way. Not in one big shot, but a very high, sharp ratio manner. The reason it worked is not because I'm a genius, it's just because machine learning and data-driven trading works. The three things I want you to understand is the one, data-driven trading works. It's unlike what you hear in the papers, the best you can do is just buy S&P 500 and pray. That's not the case. Data-driven trading works. Second, it's about technology. It's about flawless execution. Not about, relationships or whom you know. It's about just doing the work very well. Third, the future of data-driven trading is deep learning. At this point, I'd want to ask a question, because now we'll talk a lot about systematic trading. And before I go on to talk more about it, I want to understand, what do you guys see as common to a discretionary portfolio manager, a quant portfolio manager, and a deep learning based portfolio manager?
We'll just keep the poll open for another 10-15 seconds so everybody has an opportunity to participate. And as you mentioned before, we welcome questions very much. I know lines have been mute, but you can type your questions if you have any. So we'll try to address them during the presentation and even after the presentation, but please don't wait. If you have questions, don't hesitate to type them in. Okay, we'll be closing the poll in 5 seconds. And this is what we have, Carl.
Yeah, absolutely. I mean, there are shades of truth in A and C, but B option, which is they all have a process that they adhere to, is what I would agree with most. I was at this conference recently where an allocator, he decides about $8 billion of allocation. He was talking about the same, and he's seen the move from star traders to systematic trading. I mean, nowadays there's a lot of interest in quant trading, but you know, even 3 to 4 years ago, in pension funds and endowments, there was a lot more comfort in allocating to institutions led by traders with reputation. And he was trying to explain that, you know, it doesn't matter what the past trading record is. The fact is, the best PMs all have a process that they have honed over many, many years. And for some, that process is on an Excel sheet, and for some, that's on a Python program, and for some, it's like millions of lines of code that they use, but they all have a process. Today, we'll talk about deep learning being the right way to encode that process. So what is deep learning? Deep learning has is the first machine learning algorithm that tries to remove noise in the data before it starts predicting. So it spends the majority of its time in an unsupervised learning process where it's looking at a lot of data. Nowadays we have, you know, many terabytes of data in financial markets every day. And if you look at unstructured data, there's probably petabytes of data every day. So we need a method that can look at all the data and figure out if there's anything to note in there. This is not new. What you are doing right now is trying to figure out whether there's anything to remember, anything to note in everything I'm saying. What we as humans are very good at is to ignore stuff. And that's such a powerful ability that without this ability, as Kahneman says in his book, Thinking Fast and Slow, we would just not be able to act. If we start processing all the data around us, we would be frozen all the time. It's just so much work to be done. So what we do is we are very good at ignoring stuff, yet if a tiger comes into the room, I'll run within seconds. So I have the ability to ignore so much data, yet I have also the ability to figure out what is important to me. So that is what we need to achieve. So how can we do that? In deep learning, we take the data and we slowly summarize the data one layer at a time. Let's say the input layer has 5,000 nodes, 5,000 distinct information items. The next layer, let's say we restrict to just 1,500. The next layer 500, the next layer around 150, and so on, till we end up with, let's just say, 5 nodes. This is a deep neural network, but we can think of it as a PCA. I'll tell you what's the difference between a deep neural network and a PCA later. But overall, what we are trying to do is take all this information and figure out what 5 summaries of all of this can describe all the data that I got in. Now, on this slide, I'm showing a facial recognition example of this. The reason I'm showing facial recognition is that it's easy to visualize, but the same holds in any other domain, like trading. So when our eyes see an image, they don't immediately start matching pixels to, like, this looks like a computer, because I've seen these pixels before. Now, what it tries to do is first tries to see the parts that are bright and the parts that are dark. And between them, it says these are the points where there are boundaries. So you see the layer 2, the to identify edges and simple shapes. Then using using these layers, the computer tries to identify, okay, this looks like an eye, this looks like a nose. And then at much higher levels, it's able to say that, you know, 2 eyes and a nose and mouth, etc., makes a face. This is very different than how we currently approach trading. In trading, what we do is we look at every data item and when we ask ourselves, is there a signal in there? Is there like, what's the correlation? What's the R squared? How much money can I make? I don't, you know, and humans don't look at a pixel and say that, how will this help me go about my life? We just try to take that data point in perspective and figure out what's the summary of all the data we are getting before we start acting on it. In terms of our use of deep learning, I'll give you an example of how we did that later on. But why this helps us now is can be understood better within the context of this 10-year cycle that we have noticed in the innovation of quant trading. So I told you I started working roughly in about 2005, and I was lucky because I started working in high frequency trading, which was just, you know, about to grow. Let's look back. In 1987, the crash of 1987, which still is the biggest single day crash or drop in US markets history, October 19th, I think. That's when trend following became famous. Trend following, momentum also as it's called, worked before the crash, during the crash, and after the crash. In terms of risk-adjusted returns, it was through the roof. Most of the famous, you know, trend following hedge funds that you know now started around about 86, 87. About 10 years later, literally October 1997, you see a lot of trend followers losing their shirt. Niederhofer was one of the more outspoken ones, and around about that time, you start hearing about Peter Muller and other statistical arbitrage traders. So they become, what should I say, the wise guys on the Wall Street, liar's poker guys. And there's a reason for that. It's there was so much crowding into trend following around about 97 that they led to obvious opportunities that the StatArb traders would capitalize on. Imagine if you have a lot of people buying Google stock because it's just crossed the, you know, the 50-day moving average, crossed the 200-day moving average. And Google and Facebook are, let's say, very correlated. But nobody's buying Facebook because it just happens to have not crossed its 50, 200 moving averages. So at the time, there's a lot of people who are buying Google and not, you know, very few are buying Facebook. So at this time, if you sell Google and you buy Facebook, then you can you'll be sure that the correlation will hold up in some time. So you're essentially providing liquidity to trend followers for a much more safer bet. So StatArb, one reason StatArb started is because trend followers had a lot of money invested in them, and they were sort of overcrowding the market. Another reason was technology. StatArb was a much more complicated trade and needed a lot more technology, which was not very easily achievable in the late 80s or early 90s, and about 95, 96, 97. In those years, there was a lot more investment, first in banks and then in hedge funds to use StatArb. StatArb had very consistently high Sharpe ratios of 4 or 5, even till 2003-4. And then in August 2007, I think the week of August 6, 2007, it crashed horribly. Funds which had never lost money lost 40% that year. Around about that time, a new trade became famous, high-frequency trading. And again, we see the same forces play in here. There's overcrowding into StatArb. Technology needed for this new trade, high-frequency trading, was much more than StatArb. And now you see proliferation of good technologists in sort of small firms having implemented this, small firms like Tower, having implemented this new trade, high-frequency trading. And then there was the financial crisis years, first in the interest rate markets and then in broad equity markets, that led to the opportunities that high-frequency traders used. It's again, you notice this 10-year cycle, 87, 97, 2007. And now 10 years after that, you see high-frequency trading revenues are much lower. Almost every week we see headlines of sort of some firm closing or some CEO losing his job in high-frequency trading. It's because the market has caught on. People have sort of figured out the trade. So maybe it's safe to say that takes us about 10 years to figure out a trade. Now the question is, what will be the trade in the next 10 years? And my claim here, it's deep learning.
With that, I know we are getting a lot of questions, and we want to address some of them, but I'll just start our poll first, and that will give Gaurav a few minutes while everybody here is answering the poll to just take a quick glance at the question and see. So the poll is up now. What makes traditional scientific research difficult in finance? And we'll have the poll up for about 10 more seconds. Okay, I'm gonna close the poll, and here are the results.
Yeah,
I think this was an easy one, Gaurav.
Yeah, no, this is an easy one, but this is what towards the goal of investing a science. The fact is that unlike pure sciences, investing is not a pure science. So finance is not a pure science. It's a social science where truths will change as the market changes. As George Soros writes in his book, people ask, what's the fair price? And I generally tell them that it is what you will buy at, because you determine the price. And if I know what everybody will buy at, then I know the fair price. Or if I can tell everybody that buy at this price, then I know the fair price. So there are no universal truths. However, machine learning methods like deep learning, which have worked very well in social science settings, are have a higher chance of working.
So I'll just, before Gaurav, you jump on to the next slide, I'll just take two questions here for you,
Sure.
If you don't mind. Stanislav and Jiten are both asking that you talked about facial recognition.
Mm-hmm.
Will you be covering a real example from financial markets later?
Yeah. I think it's in the next few slides. I'll talk about how we use deep learning.
So I think that's a very relevant question, because this is something we get a lot, that, oh, facial recognition, I get it, but how is it used into the financial market? So we will be covering an example on that, guys, in just a few minutes. Same question by Jiten as well. It's very difficult to extrapolate from image recognition to trading strategy. So we will get to that very quickly. So let's do that, and then maybe we can take, do you want to take one more question now, Gaurav, or?
Sure.
Okay, so we have one question from Ken Keller. What's your ML stack?
So we are using Keras, which is built on TensorFlow, and a lot of our research is in Python, and all the strategies are implemented in C++. So that takes some work there. However, so for the deep learning work, we are using Keras.
Okay, thanks for that. So we'll go ahead, and I know everybody's keen to see a real example, so we'll talk about that in a little bit. Ricard, do you want to continue?
Sure. One sec. Okay. So before I talk about why now, let me talk about how to visualize applying deep learning.
This time we're discussing financial markets, right?
Yes. So imagine you have layer 1 is returns of about 5,000 stocks, and you have you pass this through what is called an autoencoder, where you learn one hidden layer with one node, and you try to replicate in layer 3 what you got in layer 1. So that's an autoencoder setup, which means that I am taking all this information on 5,000 data points, I'm reducing it to one node, that like one function, if you will, of all these 5,000 points, and with that one value, I have to reproduce all these 5,000 values. What would be, I'll give you guys a couple of seconds to think, what would be a good summary of these 5,000 points from which you can recreate what the returns of these 5,000 stocks would have been. So let's say yesterday, we take the returns of 5,000 stocks, and we try to find one summary of it from which we can recreate the returns of all these 5,000 stocks. So, when I asked this in stack, what would be the one number? The most common answer I got was 42, but I think most of you here will guess that it's probably the return of the market, and then from that you can use qplum betas to extrapolate it and say that this is how each of the stocks should have moved. That's now take that idea into a longer network, a deeper network. You take again these 5,000 points and have about a 7-layer autoencoder that finally ends up with 3 nodes. Each layer shrinks the nodes about 1 to 1/3 of the previous, and then finally from these 3 nodes you again decode it into 5,000 points. So the reason the reason this deeper network is much more powerful than a single layer network is because at every layer I'm just trying to solve a simpler problem of clustering very similar nodes. In a 1-layer setup, especially if my activation function is linear, this is nothing but principal component analysis. But as you know, PCA is a linear process, and PCA off of PCA doesn't make sense. You can only do PCA once. A deep neural network can be applied on top of an application of it, so you can stack the autoencoders on top of each other, and this way every layer you're having to do less work, and that work you can do with a much higher accuracy. So this is how we use it. You can this is what is called a normalization trade on the street. So you'll take all the returns of a stock. Let's say you take the returns of last 5 days of 5,000 stocks. You pass them through the 7-layer autoencoder, and then decode them back to these 5,000 stocks, what the returns should have been. and then you see what it should have been and what actually happened, and the difference between them is what you think will happen. And the benefit of this approach is that you're not doing any feature engineering yourself. The network is learning the features. The network is updating itself. The 3 nodes that it's learning in the 7th layer, you can visualize what those nodes are by selectively turning them on and seeing what you can visualize in 2 ways. One is you can see which of these stocks are getting sort of activated by that one of those 3 nodes, or you can try to say in the past, what have been the returns of these 3 nodes, and that way you'll be able to say, oh, this seems to be similar to developed markets, or this seems to be risk-off sentiment, you can use this as a normalization trade. This is another example. Here, since we took the data in markets just after the US election till the end of the year, the graph on the top shows what happened to US stocks, US bonds, emerging market stocks, and emerging market bonds. And then we passed it through our autoencoder, and we are showing graphs of what should have happened in each of these products if you take all 4 of them together and you try to do the same autoencoder process. So look at the part between November and December. And what we essentially did was that if you summarize the period from November 7th, the election was on November 8th, so November 7th to the end of the year, and you ask me one sentence that describes what happened in those petabytes of data, it would be that US bonds sold off. Now from that worldview of US bonds sold off, and the reason I'm saying it's US bonds sold off is because the other 3 lines are very close to 0. They are not, you can ignore them, simply speaking. That's how humans, we can ignore them. There's no information in there. Now you take the worldview that US bonds sold off and you recreate what should have happened to everything else. So okay, so US bonds sold off, what should happen? Let's see. Stocks should have gone up. US stocks should have gone up. Yep, that happened. Dollar should have strengthened. Yep, that happened. Emerging market stocks should have gone up. That didn't happen. So there's an opportunity. And true enough, this year, emerging market stocks outperformed US stocks by about 7%. So far, they have outperformed by about 7%. Same, emerging market bonds, you see that they fell a lot, but they should not have. And again, emerging markets bonds outperformed US bonds by about 5% this year. This is another example of how we use deep learning at qplum.
Gaurav, I'm getting some questions regarding if the slideshow will be shared and the recording will be shared, and I just want everybody to know that yes, Interactive Brokers will be sharing the slides and also a recording, and they will be also distributing it to everybody who is here participating in the webinar with us. So please don't worry about taking snapshots or snippets. We'll be sharing everything with you guys later.
Okay. Now, coming back. Now, see, people talk about a lot of things, and as I mentioned, humans are great about figuring out what is noise and what is relevant, and what actually matters. Now, we have to talk about why now. Why are we talking about deep learning now? It's not new. It's been there since 60s. Neural networks have been there since 60s, 1960s. And what is new is our understanding of deep neural networks and our understanding of how to learn from very little data, or how to learn in a setting where there is a lot of data but very little information in that data. So firstly, high frequency trading and systematic trading have led to an explosion of data. Like every day there's so much activity in markets, and potentially every one of those trades or orders could have a lot of information, but how do you know? We need a machine learning algorithm now that directly tries to figure out what is information before I start predicting. You know, figuring out information from data is not easy. We have to focus on that. We have to choose a machine learning algorithm that does a good job. The traditional quant approach does not. I was presenting at NVIDIA's annual deep learning conference, and I was telling them, frankly, the reason I'm here is because NVIDIA has helped us a lot. Now with GPUs and the top of the line GPUs, you can do studies that are about 100 times faster than what we could do even like 8 months ago. 100 times faster. It's very important for a startup to have these things available, because innovation always happens in small companies, in small groups. The largest companies who are making billions of dollars, they don't need to innovate. They generally do not innovate. So for a small company with small budgets, it is very important to have these tools available. So GPUs, customized hardware, software like TensorFlow, PyTorch, Keras, data infrastructure tools like Hadoop and Spark, DevOps tools for us to be able to spin up 400 machines if we need to. These are absolutely essential for a firm to be using deep learning, and they were not there earlier. Like I said, trading is a social science, and until recently, most of machine learning was focused on pure sciences. You see how most finance books talks about geometric Brownian motion and like methods that probably are more applicable to how how stars move than how our emotions do. So this is people who have been in the industry will understand this. But there's been a real shift in power, in reputation, in recent years. Now people have come to believe that star traders don't make money. Now people understand that complex, flawlessly implemented systems are the right way to derive information from data. 5 years ago, if you had, suppose you're working at BlackRock Asset Management, and you go up to the CEO and say, hey, I want to use deep learning, and if we are ahead of our time, we'll make a lot of money, and all great things will happen. They will tell you, please go and use it somewhere else. Don't touch my money, because it would be a huge business risk. Today, almost everybody is sort of investing in deep learning and other machine learning systems, in data infrastructure, DevOps. You see hedge funds hiring people in roles that they didn't know earlier was needed. And one second. Sorry. And finally, because we are doing all this work in computer science, especially West Coast, people in West Coast have made a lot of progress in using infrastructure well, in a way that does not require a lot of manual intervention. So yeah, do you want to take some questions, Bans?
Yeah, with that, how about we take some questions, Gaurav? I think we're getting a lot of questions here, so I would really like for us to take a few. Okay, so let's I'm having trouble picking which one. So, okay, let me just start picking randomly at this point. So we have a question from Al. How quickly does deep learning adapt to a substantial change in the market environment, like moving from a major up to a multi-year consolidation pattern?
So deep learning is a method, and the input that you give to this machine learning method, it'll try to understand summaries from that. For instance, if you supply daily returns data, then it will try to understand patterns in there. However, we have tried to use deep learning with about 70 years of US investor data. We took all the data that we could from Federal Reserve about how US investors have invested, and we have tried to find patterns in that. We try to see where do we find overcrowding, where do we see people sort of following the trend. The point is that we were able to figure out both the equity crash of 2000 and the housing real estate crash of 2007. So you can, if you use it with the right data, it works. With longer dated experiments, you'll have to sort of have the right goals. You're not shooting for like 5 Sharpe ratio there. You are your goals have to be clearly defined. So for instance, if I take this 50 years in US investor data and I try to find a strategy, then I'm not shooting for 5 Sharpe. I'm just trying to make sure that I am learning from the data, and I'm making sure that I'm not following the like I'm able to circumvent the crashes.
Okay, Gaurav, do you want me to move the presentation to the last slide, or
Sure.
Do you want to take a few questions and then come back?
No, let's do questions.
Okay, yeah, we have a lot of questions, so I want to give a fair amount of time to the questions here.
Mm-hmm.
Okay, the next question we have is, can you tell us if there is a time at DL? Can you tell us if there is a time when DL failed you, and how did you rectify the system?
Yeah, very good question. So when we initially used deep learning, this is 2012, it did not work. So what we did was we took the data and we used a deep neural network to predict, and the results were great in backtests, and in real trading it did not work, and it took us a lot of time and a lot of money lost to understand what we were doing wrong. What we were doing wrong was we were trying to use it as any other supervised machine learning algorithm. We would take every day the future returns of the next 5 days, let's say, and we would try to see how good is my system, what is my prediction accuracy in predicting the next 5 days. But the fact is, there isn't much information in those 5-day returns, and I'm asking it to immediately solve that very tough problem. So what we started doing 2-3 years later was we shifted our focus to unsupervised learning. So now we don't even have an objective function. We just try to take the data and figure out summaries of it. This is similar to Federal Reserve New York's Nowcast, if you want to see another example. Yeah, we try to see the summaries of it, and once we have seen patterns in the summary, then we can do 2 trades. One is normalization, and the other is prediction of the summaries, and both of these have worked much better. Okay.
Okay. We have a comment here from Balu. There is so much hype around MLDL. It's so hard to believe.
So we wrote an article on this, industry research report on this in February this year. You're right. There is a lot of hype, and when it's not just hype, it's also in jobs. So if you look at jobs, industry-wide job postings, in the last 6 years, trading-related jobs have become about 1/3 of what they were. Even quant jobs are about 20% below what they were in 2010. data scientists are up by about 30%, but AI-related jobs are skyrocketing. Fintech-related jobs are skyrocketing. So yes, there is a lot of hype in the sense there is a lot of sudden increase in the investment in AI and in the scope of where it's being used. But there's a good reason. The good reason is that we have seen it work in other billion-dollar industries like ad tech, like e-commerce, now even driverless cars. And we now have seen it in our industry. In high-frequency trading was the first example, and I say that in a research report here. I can share all this later with you. High-frequency trading was the first example where we did not start with a hypothesis. We did not say, this is the trade I'm looking for. Can I find the data to support my claim? No. We said, this is the data I have. Let me run it through my machine learning model, and whatever the model says, I will do. And we've seen it work.
We have a question here from Patrick. How do you make actual trading decisions based on predictions of your neural networks?
So like I mentioned, after you have got your summaries from the autoencoder process, then you can try to do two things. One is you can try to use that as your worldview and figure out what should have happened to each of the products. I'm calling that a normalization trade. That if this is what, if things are normal, then this is what should have happened to each of those stocks, futures, or options from these summaries. It's very natural. If I tell you last 5 days markets have gone up a lot, and now if you find that stock is basically flat, then you'll say, this is a good buying opportunity. That's literally what a normalization trade is. And the other thing you can do is you can take these summaries and you'll find some of these summary features to be very predictable. For instance, we found some of these summaries are related to risk taking in the market. And as you know, VIX index or other measures of risk have a predictable pattern. They go up fast and they come down slowly. They are much more predictable than the stock market itself. So if summaries themselves are very predictable, then you can do that, and you can have a decently high accuracy in predicting the future values of the summaries, and from that you can extrapolate it to what will happen to each of my products.
This has been asked by a few people here, Gaurav. The latest it's been asked by Al. Is all your input data based on historical data?
Of course, to be systematic, to be data driven, and not to overly expose yourself to your biases, we have to rely on historical data. The only sort of situations where we, from a trading perspective, don't stray from historical data are situations like elections or Federal Reserve meetings, where we don't know what will happen in the event, but we know that there is an event that's going to happen, and hence from a risk management perspective, we know that event risk will be high, and you will sort of reduce the risk in your portfolio.
And I think, Gaurav, that probably will need another 1 hour of presentation if we were to discuss how we combat historical data problems and how we deal with them. We have a question here from Tapas. What, if any, would be your concerns in using deep learning from trading?
The main challenges are to use it well. They say that the human mind has the deepest network in the human mind is 4 million layers deep. The deepest network that we have worked with is just 10 layers. Why? Because it's very costly. It's very costly to work with deeper layers. But the deeper you go, literally the more intelligent you get. So I have to figure out how to use it well, how to rely less on the features that I have put in, and how to trust. invest in the knowledge of how to use deep learning well.
This question has come up also. This question was asked by Mahinder, and it's been asked by a few other members as well here. If everyone uses deep learning for investing, then why should we come to you? Why not others? Also, does it work at the time of depression and down markets?
Well, two questions there. So the first one, everybody, since you've directly asked me, I'll refer to my qplum. So it's not the case that everybody is using deep learning. It is probably less than 5 firms are using deep learning at a high quality currently. To give you an example of who is using deep learning, Renaissance Technologies, the 2 heads of trading at Renaissance Technologies, Bob Mercer and Peter Brown, where they joined Rentech from AT&T Labs in 2004. Before that, for many years at AT&T, they were working on deep learning. That's we have to, our hats off to Rentech. In 2004, they got 2 guys in a new technology that was yet to be have this sort of a reputation, and today they are heads of trading of a 40-year-old firm. So it's not that we are the only ones using it. However, I think your main question is that if everybody starts using this method, then will there be any alpha left in it? I think that with deep learning, we finally have an opportunity that we'll stop talking about alpha and start talking more about quality. For instance, with search engines, we don't say, what's the next search engine that'll come up? Google has become a good enough solution, unlike the solutions before, and it's possible that with deep learning, we finally might be at a position that the technology itself can adapt with as times change, and this might be the only method to use going forward.
Umesh Jain is asking the exact same question. If more people or companies start using deep learning, wouldn't price be optimized to the point where the advantage will be minimized?
So the main function of investing is not to make money at the expense of others. It is to figure out that there's all this data coming into markets. How does that relate to pricing and what's going to happen, and how to derive information from it? And yeah, if everybody uses the best method, I genuinely feel that that is the solution that we are looking for. I mean, when I say investing can be a science, I'm hoping for this day. I rather dream for this day where every one of us is using the best method and we are not competing against each other. It's becoming a genuinely inclusive process. It's going to take some time, but yeah, that's the hope.
I think we're getting quite a lot of questions here, Gaurav, so I'll try to quickly go over some questions faster. Asim is asking, how can we know that we are well past the utility of relatively simple linear models in, say, StatArb?
Good question. So I think there are returns, and you can see StatArb funds have basically since 2012 have not been making money. But it's not so much about returns, it's about the approach. See, the linear methods at the final stage of classification with linear logistic, that's not a problem. Deep learning itself uses logistic regression at the end, but can also use linear regression at the end. The main innovation here is in the feature engineering. The main innovation here is not to hire thousands of people to make alphas to feed into your quant model and pick the top 15 Sharpe ratio alphas and blah, blah, blah. The main innovation here is to let your system find the features that explain the data, because then you will have a much higher chance of not overfitting.
Okay. I'll take some questions that came earlier, Gaurav, so that everybody kind of gets the opportunity. Robert asked us, how do you input stock data into your neural network?
Yeah, so as I mentioned, we look at data at different frequencies. We look at every tick by tick data from the markets, literally every single update from the markets. And on the other hand, we look at since 1950, so close to 70 years of history of how investors have invested, and different indices that we could get our hands on. All this data doesn't go into the same model. We use different models. To use all of this in the same model, we'll just need a much deeper network, which we don't have the budgets for. But yeah, so we look at all of this data and we try to summarize at in different views what happened and what can we learn from that.
Okay. They all try to make sure there is less overfitting. Is that correct?
Yeah. I believe this was a response to the poll question, Mansi.
Oh, okay.
And I think
overfitting is a touchy topic here. We can spend like hours discussing it. So.
Right. And in terms of discretionary PMs, quant PMs, and deep learning PMs, no. And I think that the biggest problem that discretionary PMs face is not their ideas are not great. It's just having a systematic way to reduce overfitting is just not humanly possible. For instance, at qplum, we don't make one model. Every day, we make a new model for the next day. And going back, when we backtest our system, so let's say July 13th of 2005, we will make sure that a model that we use to backtest on that day only looks at data till July 12th of 2005. There is no way for us to overfit on that day. This is called walk-forward optimization. It's not unique, but it's just so much work to implement. And walk-forward optimization in the context of deep learning, that means a lot of computation. That's the hard part.
Was deep learning used in 2004 to 2010?
Not to my knowledge. I mean, again, I don't know about firms like Rentec. They're very secretive, and they certainly have invested much earlier than us. But those were years where there was a lot of activity in the markets. Volatility was changing a lot, and business cycles were sort of changing. So in those years, most of the innovation was human-driven. So humans were making features, and frankly, there was just so much money to be made that that firms would freely invest in hiring people to do this feature engineering. Backdrop of all this talk about deep learning is that alphas are much lower now. Sharp ratios are much lower. It doesn't make sense to hire thousands of people to make like one sharp ratio strategies, right? So.
What would be your career advice to get involved in deep learning? I have a background in hedge funds, never did much trading, did CFA, and currently work as a software engineer in Google.
I think that you'll find about 4 to 5 firms. I'm not saying hundreds, but 4 to 5 firms really investing a lot in deep learning. I know some names, and there are firms who have called literally every professor, postdoc, and whoever they can of academic repute in deep learning. The problem is about information retrieval, and I think your work in Google will be very relevant. But yes, we are in finance. It's very much about information retrieval in a domain which has natural limits to accuracy. For instance, we cannot all have 100% accuracy, because that means all of us would be making tons of money every hour, and there's just not that much money to be made. So this is a very unique domain of information retrieval. So yeah, I think you'll find a lot of firms interested in your skills.
How does one control the low bias, high variance, over specification problem when adding large number of layers? I think the question is around number of layers more so, Gaurav.
I think the low bias is a good thing. I am not sure about overspecification. I think that is not what I've faced. Oh, you see, the problem that we are trying to solve with a lot of layers in just unsupervised learning is much simpler. We are trying to find what happened, not what is going to happen, but what happened. There we'll have much higher accuracies, and we just need to make sure that we don't overfit. So yes, it's certainly a goal for us to have a low bias.
Okay. What asset classes do we invest in? Only ETFs? Yes, we invest in ETFs here at qplum. We are registered as a CTA as well, so we will be offering derivatives soon. At the moment, in any given portfolio, we trade about 50 to 80 ETFs. Overall, we cover a universe of more than 200 ETFs.
It's a global portfolio.
Global portfolios. Yes. Okay, I'm just going to try and cover a few more questions here.
Generally, are autoencoders only one level deep to reflect basic market factors, that is 3-factor models, or have you found that you need to have many levels for the initial encoding versus having many layers after the summary is being mined for additional features?
Gaurav, can you summarize the question as well, just so everybody understands?
Yeah, he's talking about what would be a good depth of the network, and for us, the best way we have found, and this is not trivial, I think depth of the network is something that most companies, even in technology, keep close to the vest. So what we broadly found is that we shrink the nodes by about a third in every layer, and this way we are not we are not going from 5,000 nodes to 5 nodes in one layer, and we are also not like we're also staying within our budget. I think that there's no right answer to this, but practically in terms of P&L, etc., we have found this to be a good number.
Can you use your model in cryptocurrency world?
No, see, cryptocurrencies are a closed system of price action, and this is very similar to other trend following systems that we have seen. However, we don't trade cryptocurrencies, so I will reserve any opinions there.
As an ML professional, do you need a lot of knowledge about finance in order to successfully train a good model for trading?
Very good question. So finance is very unique in the sense, if you, for a problem like, can you identify from a picture, can you identify Barack Obama's face? Technically, we can get to 100% accuracy if we do a lot of work here. But in finance, we like getting to 100% accuracy, or even like 56% accuracies, it's going to be very tough. So for an ML professional, I think that's the biggest challenge I've seen, is to understand this fight against overfitting and all the work we have to do so that we don't overfit. That will be the main mindset change you will need to work in finance.
Okay, here we have a comment from one of the viewers that again, it's very similar to what somebody else also pointed, Gaurav, that if everybody uses this, markets will converge and there will be no earning money at expense of others, but it will significantly increase efficiency of the economy and capital allocation, which will bring huge benefits.
Yeah, I quite agree. I mean, we are all, I would say, one of the smartest few in the world of investing, but practically for most people who are disillusioned from the world of investing because they feel that there are smarter people out there who are making money at their expense, it's for them that this will have the biggest benefits.
Okay, with that, we'll take one last question, and then we'll kind of be closing the webinar and handing it over back to Cynthia here. Let me see, I'm just going to try and find one question that we can quickly take. Okay, for someone who only knows how to put orders through a trading platform, one who doesn't know programming? What is the path for a complete newbie here? I think that's a very good question, Gaurav, because a lot of people feel like this is so hard, this is so complex, the hurdle is so high, and I know something from before. How do I start learning? Where do I start learning from?
So I think the world of investing has reached a complexity level that, frankly, we should not be trying to battle against machines and by using our own intuition. I mean, I think that the only way forward is to use a fairly sophisticated system. It's sort of like we don't try to make our own search engines now. I mean, I for one have seen, I've done really well at my trading, and I've seen how others who did not have the systems that I had, how easy it was for me to make money against them. They probably did not know. They probably, it was not clear to them. But no, it's fighting against systems is.
I think it's not so much about being easy to make money. I think it's obviously very hard to make money. I think what you're really saying is that you can either fight the change or participate in it.
Exactly. Use AI. Use a system which uses AI, which is built on AI. Don't fight AI.
Yeah. And it doesn't mean that you have to turn yourself into a programmer. Just the starting point is you acknowledge the presence of a system. You start to acknowledge that, okay, I have to embrace this technology. Now, whether I have to learn it, whether I have to be the programmer, the coder, the person who implements it. But the beginning is, you acknowledge it. I think that's where it all starts. With that, we will just take one more question, since questions are constantly coming. Is this used mainly for long-term trading, or can it also be used for day trading, like in mini S&P futures?
So, Nick, it certainly can be used for day trading. It can be used in a 30-minute space as well. Is the data that you give it? It's very simple. Anything you can do as a human, this can do. So, for instance, if you pour yourself into looking at day trades, and you sort of learn how things move within the space of a day, then that is exactly the pattern. And time was too short, but we do use it in a higher frequency execution framework as well. In the long-term space, the Mansi used to work at Brevan Howard, one of the largest hedge funds, where they were long-term traders, but they fought this change. They were not using technology, and now multiple years of redemptions, and you can see how starting to use it is much better than assuming that will not be used.
At qplum, do we make use of deep reinforcement learning for automatic trading?
Yes.
Okay. With that, I will hand it over to Cynthia. And as I mentioned earlier, we really enjoyed the presentation. I'm so sorry we couldn't take up all the questions that were sent to us. I tried to balance it out as much as I could. But if you have questions that were not answered, you can email us at contact@qplum.co. And Cynthia, whenever you're ready, you can take back the voice and the presentation controls.
Well, Mansi, thank you so much. And Gaurav, fascinating presentation. I do appreciate all the effort that you've put into this. And I also would like at this point to thank everyone who has participated in our session today. We appreciate the time that you've spent with us here today. Now, I do want to let you know that we will be, or that we have been recording today's presentation, and each of you will be getting a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review any of those concepts that were discussed, simply watch your email later on this afternoon, and you'll get a direct link to that playback. Also want to let you know that the recording has been, or the webinar notes will be emailed to you as well. So simply watch your inbox later on today. I also do want to mention that both the recording and the webinar notes will be posted on the Interactive Broker website. Underneath the education menu, you'll find a webinar section where you can come back and review today's presentation plus any of our other archived events. So with that, we are going to conclude our session today. Want to thank all of you for your participation. Have a great rest of your day, everyone, and all do remember to trade smart. Thanks, everyone, and special thanks to qplum for today's presentation. Have a great day, everyone.